If you've ever looked at a balance sheet and felt like you were reading ancient ciphers, stop. Accounting isn't actually about math, it's about balance. Every multi-billion-dollar corporation, from Apple to your local coffee shop, runs on one single unbreakable rule. It's called the accounting equation. Master this, and you master the language of business. Here it is. Assets equal liabilities plus equity. Think of it like this. Everything your company has, their assets, was paid for by someone. Either you borrow the money from a bank, a liability, or it came from the owners and their profits. That's equity. In accounting, the left side must always equal the right side. If it doesn't, someone made a mistake, and an accountant is probably losing sleep over it. Let's define the players. Assets. These are the cool things. The business owns cash in the bank, inventory on the shelves, the delivery truck, and even the building itself. Liabilities are the money you owe. It's your credit card balance, your bank loans, and the bills you haven't even paid yet, also known as accounts payable. And the equity is also known as the owner's claim. If one day you decide to sell all your assets and paid off all the debts today, whatever is left over belongs to you, which is also your equity. Let's see a week. Imagine you start a lemonade stand. To start off, you put in $100 of your own cash into the business. Your equity goes up to 100 and your assets also increase to 100. You then borrow $50 from your mom to buy a fancy pitcher. Your assets go up to $150, but now you have a $50 liability. It's still balanced. You then spend $20 of your own cash on lemons. One asset, the cash, goes down, and another asset, inventory, goes up. The total stays the same, and the scale doesn't move. After your first day of operations, you profit $40 from your lemonade stand. As a result, your assets increase by $40, and so does your equity. Equity only increases or decreases when you invest money, withdraw money, or the business earns profit or incurs a loss. And let's say if you pay back your mom the $20 of the $50 that you owe her, from the pitcher, your assets go down by $20, and so does your liabilities. And since you did not earn a profit or incur a loss during operations, your equity does not change. Why does this equation matter? This equation tells you the health of a business. If liabilities are huge and equity is tiny, that's a red flag. If assets are growing and equity is too, you're building wealth. Remember, assets always equal liabilities plus equity. Keep your scales balanced, and you're already ahead of the game.